In this module, we will be talking about the concept of a lease, specifically the categorization of operating versus capital leases. So what we're really talking about here is a company that instead of purchasing the asset and using it, having a debt, instead of doing that, they want to lease the asset, perhaps to give them more flexibility or to make the financing easier. So again, one option here is for the company to purchase and record an asset and liability in the equal amount. In other words, if you have a piece of equipment that costs you $100,000, you may borrow $100,000. So you'll have both an asset and a liability. Now, the problem with this from a company's perspective is that if you increase both the assets and liabilities in the same amount, your company is going to look as if it's a little bit higher risk than had it not purchased the asset at all. The reason for this is the debt ratio. We have liabilities divided by assets. Now, the way math works, even though intuitively it would seem that if you increase both the numerator and denominator by the same amount, it would seem that your ratio is going to stay the same until you really think about it and work out the math. Let's take a look at an example. We have liabilities of $500,000 and assets of $750,000. So our current debt ratio is 66.67%. Now let's say in my example we bought an asset through borrowed money for $100,000. So we're adding $100,000 to both the assets and liabilities. It's the same amount. However, your fraction increases. Now we have liabilities of $600,000 and assets of $850,000, gives us a 70.59% debt ratio. So as you can see here, even though you're borrowing money and getting an asset in the same amount, your percentage of debt ratio is still going to increase. Companies don't like to see these high risk ratios, so they may try to avoid this particular transaction any way they can. So for decades, before the rules changed, companies started to get wise to this, and they said, well, you know what, if we don't buy the asset and record the debt, then we're not going to have the issue with our debt ratio. Maybe we could lease these assets. So leasing, you'll often hear this referred to as off-balance sheet financing. The reason for that is that you're keeping both the asset and the liability off of the books, off of the balance sheet. So as this became more popular, various leasing companies arose that started to offer these transactions. They essentially bought the equipment, turned around and leased it to the company that wanted to buy it in the first place. So this, again, was in place for decades. But as the accounting standards started to catch up to this, they realized that perhaps this isn't really the best way to record this. Perhaps this is a situation where the company is trying to hide this debt and hide the asset too, admittedly. But again, they're hiding this transaction so their debt ratio doesn't look so high. But the question with this is, how much does the company actually use the asset compared to how much anybody else might use the asset? How long are they using it for compared to its life? How much of the total value of the asset did they have to pay? And really what it boils down to is, should this still be considered a liability because you do owe the lease payments down the road? That's the thing to keep in mind. Even though it's a monthly payment, you still owe it. You've locked yourself into an agreement for perhaps 10 years. So why is this not being recorded as a liability? Now, before we get too much further, I want to clarify a couple of terms. They're very easy to mix up. Lessee versus lessor. The lessee is the person actually leasing the equipment to use it. It's the company that wants to use this equipment. I'm comparing this to a buyer, if somebody was buying an asset. A lessor is the original owner of the equipment, the person leasing it out to somebody else. In other words, you could think of this as kind of the seller. So again, it's very easy to mix these two terms up. The best way to think about it, the best way when you're looking at these, we have seller. And if you look at lessor, If you mix around some of the letters, you get really close to seller, or sellor in this case. Maybe that's the best way to remember which one is which. Seller and lesser, those two words look closer than lessee and buyer. So hopefully that helps to clarify it a little bit. It's easy to get them mixed up. So again, due to all the issues we've been talking about, the concern with this debt not being reported, even though it's going to be owed over the next 10 years, the accounting standards, GAAP, changed in 1977, and they created two separate types of leases. The first type of lease would be your standard, what's known as an operating lease. This is basically a true lease, a true rent type situation. This is going to be treated the same way as all leases were previously. You don't record an asset. You don't record a liability. You essentially have rent expense or lease expense every month. That's all you're recording. A capital lease, on the other hand, this is a situation where we've taken a look at the lease, and it really is more like a purchase. So we'll talk about the criteria in just a bit, but if a lease actually hits any of these criteria, if it meets any of these criteria, then we're going to be calling this a capital lease, which will be treated like a purchase. It's not going to be treated like a true lease, because the thought here is that the company was entering in this transaction solely for the purpose of keeping this asset and liability off of the books. They would have otherwise purchased the asset. They weren't looking for the flexibility that leasing offers. If they were just looking for the flexibility, it would be treating it as an operating lease. But here they were essentially purchasing the asset. So we're going to force them to treat this very similar to how they would if they actually purchased the asset. They'll report a lease asset and a lease liability, and they will treat this asset as if they were the owner. They will record depreciation expense and every other expense you may need. So let's take a look at the four criteria. The first one is pretty straightforward: automatic ownership transfer. If that lease specifically states that once this lease ends, the lessee will be the owner. In other words, the ownership transfers from the lessor to the lessee. If that's the situation, we're going to call this a capital lease. We're going to treat it just like a purchase. It's almost like a deferred purchase. If this is a bargain purchase option, so perhaps a company and a leasing company tried to get around that automatic ownership transfer, and they basically said, hey, this is not an automatic ownership transfer, but you just have to pay us a small nominal fee, and now you're the owner. If that's the case, it's going to be a capital lease. Now, bargain purchase option. What is considered a bargain? So we know what the fair market value of the asset would be at that time. If the bargain purchase option is priced significantly below that, in other words, that lessee gets a better deal than any other customer would, considerably better deal, then we're going to call this a capital lease. Those two are pretty straightforward, but now we get into the quantitative ones. If the lease term is greater than 75% of the asset's economic life. So if this asset has a life of 10 years, and we're leasing it for 8 of those 10 years, which is 80%, the thought here is that we've used up more of that asset's value than any other customer will be able to, so we should be treated as the purchaser of the asset. The fourth one is the most complicated of all. It says if the present value of all the minimum lease payments, everything we are required to pay, if that's greater than 90% of the asset's fair market value, we've paid so much of this asset's value that we're essentially buying it. So the trick here, or the complicated portion, is the discussion of present value. Now I'm going to be talking about it in a little bit, but if you go back to our bond pricing module, we talk more about present value. We talk about the actual factors, what to use. So for now, we're just going to keep it at a fairly high level. The lease payments, the minimum lease payments we're talking about, would include the minimum rental payments, the guaranteed residual value. In other words, if we enter into this lease, we're making sure that we're taking care of this asset, and we guarantee that this asset will be worth a certain amount of money by the time we give it back to the lessor. In other words, we're not going to ruin their, let's say it's a vehicle. We're not going to destroy their rental car and give it back to them and it has no value to it. Bargain purchase option. This is the minimum, part of the minimum payments we can include, and any sort of non-renewal penalty. So if this lease was set up in 5-year increments, and if we didn't renew it, if there's some sort of penalty built in, that would be part of our lease payments as well. So essentially we take all of these lease payments and we find the present value of those lease payments. Keep in mind, some of those will be a lump sum amount. The guaranteed residual value, for example, will be one payment, but some of them are annuity payments. The lease payments themselves, the rental payments, those are annuities, so you'd have to use the present value of an annuity factor for that. Again, we go into that in more detail in the pricing of a bond module, as well as the separate time value of money module. So if we do hit any of those criteria, we're going to treat this lease as if we were the owner of the asset and we borrowed money to buy it. We're going to report the payment of liability, and we are going to report the depreciation of the asset as well, just as if we were the owner. So now let's take a look at the actual journal entries that would be needed here. If this was an operating lease, when we first enter into the lease, there's no entry needed. However, every lease period, we would have a debit to lease expense and a credit to cash for whatever we paid. Keep in mind, there's nothing that we reported initially, therefore there is nothing on the balance sheet. No asset, no liability. If this were a capital lease, on the other hand, the initial entry into the lease, we would have to calculate the present value of those minimum lease payments, and that's going to become the cost, so to speak, of the asset, the value. We would debit the leased asset, credit the lease liability, and it looks as if we borrowed a certain amount of money and we recorded an asset. Every lease period, then, what we would be doing is debiting lease liability to reduce it because we paid it off, and crediting cash for the amount we paid. The second entry that would be needed is that we would have to debit depreciation expense and credit accumulated depreciation for the portion of the asset's value that's been used up. So that would be your normal depreciation calculation. So again, we are reporting a lease liability on the balance sheet, and it would decrease over time as we pay that lease off. And we would also be reporting a leased asset less the accumulated depreciation, which over time that would eventually drop down to the actual salvage value of that asset. Now I have one additional slide in here. This actually starts to dig into more of an advanced topic, but I want to bring it up just so you're somewhat familiar with it. For the seller, we have to take a look at how do we treat this for them. We've been looking from the buyer's perspective or the lessee's perspective, but now we want to take a look at how does the seller treat this. If this is, it really depends on what are they in the business of doing. If they are an equipment manufacturer who also happens to lease their product out, this would be a sales type lease. So this is when a manufacturer sells the product through leases. They offer that flexible payment option. What they're going to record when they sell that, this is if it's a capital lease, they're going to record the profit margin as well as interest from the leasing transaction itself. So they're going to have two types of revenue. Interest revenue, and then just your normal sales above cost of goods sold, your gross profit margin. Again, we get into much more detail on how to calculate these in advanced modules. But then we have the direct financing lease. This is where you have an actual leasing company that they purchase an asset from a manufacturer, they turn right around and lease it. They're not trying to make a profit margin on the product itself. They're trying to make their money through financing. So the only type of revenue they will record is interest from financing. Now, again, as far as in future more advanced modules, we talk more about the present value calculations. We see actual examples of these leases from both the buyer and the seller perspective, or the lessee and the lessor perspective. Hopefully this helps to give you an introduction into what you would need to know for your basic accounting classes.